If you're over 60 and regularly move money through a checking account, there are 3 records being created behind the scenes that you may never see until one of them causes a frozen transaction, an unexpected bank question, or a letter from the IRS. Your bank may record a large cash deposit. Its monitoring system may examine a series of unusual transactions, and a payment app may send information connected to money entering your account. None of that automatically means you've done anything wrong, but when the explanation for your money exists only in your memory, an innocent transaction can become much harder to defend months or even years later. Today, I'm breaking down all 3 records, the common misunderstandings surrounding the $10,000 number, the mistake people make when dividing a large cash transaction, and the family payments that can look completely different on a tax document than they did on your phone. Stay with me until the end, because the third situation is the one most retirees dismiss as harmless, and it's also the one most likely to create a confusing mismatch after a tax return has already been filed. Welcome to Retire Smart with Olivia. Every week we make retirement rules, banking issues, Social Security, taxes, and personal finance easier to understand so you can protect what you've spent a lifetime building. Subscribe if you want clear explanations without the complicated government language. Now, the first record begins with a number almost everyone has heard, $10,000. Many people believe that depositing less than $10,000 keeps a transaction invisible. Others believe that depositing more than $10,000 automatically puts them in trouble. Both ideas miss the real issue. When someone conducts more than $10,000 in cash transactions through a financial institution during one business day, the institution is generally required to file a currency transaction report. This applies to actual currency, cash and coins, not an ordinary electronic transfer or a check simply because it exceeds $10,000. The report can include identifying information about the person conducting the transaction, the account involved, and the amount of cash handled. But here is what matters. A currency transaction report is not an accusation. Retirees sell vehicles, withdraw money for major purchases, receive insurance proceeds, consolidate emergency cash, and make perfectly legitimate transactions every day. A report can be filed even when the money is completely legal and properly documented. The mistake is assuming the report itself is dangerous and then changing your behavior to avoid it. Imagine that you sold a used pickup truck for $14,500 in cash. You are uncomfortable depositing the entire amount, so you deposit $7,000 on Monday and $7,500 later in the week. From your perspective, you are simply being cautious. But from a compliance perspective, dividing cash transactions specifically to prevent a required report can create a much more serious concern than depositing the full legitimate amount at once. That conduct is known as structuring. The critical issue is purpose. An ordinary series of smaller transactions is not automatically illegal simply because each one is below $10,000. But intentionally breaking up cash deposits or withdrawals to evade reporting requirements can be. That is why the safest approach is not to play games with the threshold. Make the legitimate transaction naturally. Keep the bill of sale, settlement statement, withdrawal receipt, inheritance paperwork, or other record explaining the source and purpose, and answer your bank's questions honestly. Your bank may ask where the money came from or what it will be used for. That does not necessarily mean you are under investigation. The institution may simply be completing legally required record keeping. The first danger, then, is not crossing $10,000. It is allowing fear of the number to push you into a pattern that is harder to explain than the original transaction. The second record is more secretive because there may be no fixed dollar amount that guarantees whether something will receive attention. Financial institutions use monitoring systems to identify activity that appears inconsistent, unexplained, fraudulent, or designed to evade reporting. When an institution determines that activity meets the applicable requirements, it may file a suspicious activity report. Customers are generally not notified that such a report was filed, and the institution is restricted from revealing its existence. That sounds frightening, but it is important not to jump to the conclusion that every change in your spending creates a federal case. Banks examine context. A retired person taking out $600 every 2 weeks for household expenses is not automatically committing structuring. A widow withdrawing more after her spouse dies is not automatically suspicious, and moving money between accounts you own is not automatically taxable. Problems arise when activity changes dramatically. The explanation is unclear, the source of funds cannot be supported, fraud indicators appear, or the transactions seem deliberately designed to conceal what is happening. Consider Ellen, a fictional example based on a situation many families face. Ellen is 69 and has always paid most expenses by debit card. After a severe storm damages her home, she begins withdrawing cash to pay several local contractors. In 1 month, her account shows multiple withdrawals that are much larger than usual. Her bank contacts her to confirm that she authorized them. Ellen becomes nervous and says as little as possible because she assumes the bank is trying to accuse her of something. But the bank may also be trying to protect her from elder financial exploitation, account takeover, or contractor fraud. Had Ellen kept the estimates, invoices, and receipts together, she could explain the sudden activity clearly. Instead, she now has to reconstruct everything from memory. That is the lesson behind the second record. Unusual does not mean illegal, but unexplained activity can create unnecessary complications. You do not need to keep a diary of every cup of coffee. Focus on transactions that differ meaningfully from your normal routine. Large cash movements, the sale of property, payments to caregivers or contractors, money received after a spouse's death, transfers involving relatives, or withdrawals made for someone else. Keep a short note showing the date, amount, source, purpose, and any supporting document. Also protect yourself from one of the most dangerous situations facing older account holders: allowing another person to use your account as a pass-through. A relative may say, "My account isn't working. Let me send the money to you, and then you can withdraw it for me." That may sound like a harmless favor, but now the transaction is flowing through your name, your bank account, and your financial history. You may not know where the funds originated, why the sender cannot use their own account, or what the cash will ultimately be used for. Never let anyone use your checking account to receive or move money unless you fully understand the transaction and are legally comfortable being connected to it. The third record begins with something that feels far less serious: a notification on your phone. Your daughter reimburses you for a refrigerator. Your son sends money toward shared property taxes. A neighbor pays you back for concert tickets. Or someone sends money after you sold an old piece of furniture. To you, these payments may all look similar. They appear as money entering Venmo, PayPal, Cash App, Zelle, or another service. But for tax purposes, the reason for the payment matters far more than the app used. Personal gifts and reimbursements generally are not income to the recipient merely because they were sent electronically. Money received from selling goods or providing services may have different tax consequences. And the appearance of a Form 1099-K does not, by itself, determine how much taxable income you have. Under the current federal threshold, third-party settlement organizations generally must issue Form 1099-K when payments for goods and services exceed $20,000 and involve more than 200 transactions during the calendar year, although a form may still be issued below that threshold in some circumstances. Payment card transactions and state reporting requirements can also operate differently. Zelle generally functions as a bank-to-bank payment network rather than a third-party settlement organization using the same federal Form 1099-K framework, but that does not turn business income into non-taxable money. Taxability depends on what the payment represents, not simply whether a form arrived. Here is where retirees can be caught off guard. Imagine Olivia, another fictional example, is 72 and downsizing. She sells furniture, decorations, kitchen equipment, and several collectibles online. Her family also reimburses her through the same app for prescriptions and household purchases. By tax season, her app history contains personal reimbursements, gifts, sales made at a loss, and perhaps one collectible sold for more than she originally paid. They are all mixed together. If a tax form arrives showing gross payments, it may not distinguish every category the way Olivia remembers it. She should not automatically report the entire amount as profit, but she also should not ignore the form. She needs records showing what each payment represented, what she originally paid for items that were sold, and which transfers were personal reimbursements or gifts. The same problem can happen when a family member writes a vague memo such as payment or leaves the memo blank. A memo does not control federal tax law, but a clear description, such as reimbursement for refrigerator, personal gift, or share of property tax payment, can support your explanation when combined with receipts, messages, and bank records. Never label a business payment as a gift just to avoid tax reporting. The description must reflect what actually happened. The worry many people have is that a payment form will instantly trigger an audit. That is not how every case unfolds. But the IRS does compare information reported by third parties with information shown on tax returns. When the information appears inconsistent, the IRS may send a CP 2000 notice proposing a change. A CP 2000 is not a formal audit, and it is not automatically a final bill. It is a notice explaining that information reported to the IRS does not appear to match the filed return. You may agree, partially agree, or disagree, but you must read the notice carefully and respond by the exact deadline printed on it. For most taxpayers living in the United States, the standard response period is usually 30 days from the date of the notice, while taxpayers living outside the country may receive 60 days. Do not calculate the deadline from the day you happen to open the envelope. If you need more time, contact the IRS using the instructions and telephone number printed on the notice, rather than ignoring it. Now let's bring these three records together because they create one larger risk. The government does not need every transaction to be illegal for questions to arise. It only needs information that appears inconsistent. A bank record shows cash entering the account. A payment processor reports gross payments. A tax return shows no related income. None of those facts alone tells the full story. The missing piece is your documentation. That is why your protection is not a secret threshold, a different bank, or a clever transaction pattern. Your protection is a clear paper trail showing where the money came from, why it moved, and whether it was income, a gift, a reimbursement, a transfer between your own accounts, or proceeds from selling personal property. Here is the 6-step account check I recommend completing before another year passes. Step 1. Review the previous 12 months of checking account activity and mark any large or unusual cash transactions. For each one, locate the receipt, contract, bill of sale, settlement statement, or written explanation. Step 2. Download the transaction histories from every payment app you use. Separate personal gifts and reimbursements from payments connected to goods or services. Step 3. For anything you sold, record the item, sale price, original cost if known, selling fees, and whether you sold it for a gain or loss. Do not assume the gross amount deposited into an app equals taxable profit. Step 4. Review transfers between accounts you own and keep statements showing both sides of the transfer. Moving your own money generally does not create income, but unexplained deposits can be confusing when the originating record is missing. Step 5. Obtain your ChexSystems consumer disclosure if you are concerned about account opening problems, reported closures, unpaid balances, or possible identity theft. A ChexSystems security freeze may help prevent unauthorized new accounts from being opened using your consumer file, but it does not erase legitimate transaction history, prevent banks from monitoring existing accounts, or stop information from being shared for legally permitted purposes. Step 6. Open every IRS letter immediately. Verify it through official contact information, compare the reported amounts with your records, and respond by the deadline shown on the notice. If the amount is significant, the records are complicated, or the notice involves several years, speak with a licensed tax professional, an enrolled agent, or a qualified tax attorney before signing an agreement. The most important point is this: legitimate money does not become illegal simply because your bank records it, and receiving a tax form does not automatically make every dollar taxable. But legitimate transactions can still create stressful questions when there is no documentation left to explain them. Your bank may not be able to tell you whether a suspicious activity report exists. A payment processor may issue a tax form you did not expect. And an IRS matching notice may arrive long after you have forgotten what the original transfers were for. That silence is exactly why you should build your own record now. You do not need to live in fear of your checking account. You simply need to stop relying on memory. Keep the receipts, label transactions truthfully, avoid moving money for other people, never divide cash transactions for the purpose of avoiding reporting, and respond quickly when an institution asks a legitimate question. The transaction that is easy to explain today may be almost impossible to reconstruct 2 years from now. This is Olivia, and you're watching Retire Smart with Olivia, where we help you protect your money, avoid expensive surprises, and make smarter retirement decisions with confidence.